Samir Arora is now joining us. He's founder and fund manager at Helios Capital. Samir, great to have you with us here on the program. Thank you very much. I have to say that Samir and his team were one of the first to realize and kind of, in a way, forecast. They were ahead of the curve in calling the market top, that the market is going to head lower. This was very early in the year. And then they turned constructive around the time the market actually bottomed out, mid-June or so. So keeping with that track record, Samir, are we at a bit of an inflection point now? I remember the last time that we spoke, you said, well, you know, what happens after markets sell off quite a bit is not a huge rally. You know, they should stop falling first and consolidate, spend some time. But we got a straight up 18% move higher. What now, Samir?
So I think, first of all, you call me before I can myself take any trades today or do any trades today, because all this happened after market on Friday. But I have to say that we have to give back quite a bit of it. And that is the reason why, every day Mr. Irani with his long only fund doesn't beat my long short fund, is because we have days like this and weeks like this. But I think, even though I have not yet done anything post the announcements and everything, but I think we will give back quite a bit.
Okay. Well, for now, the pre-opening rates are kicking in and it's not looking good. It's quite an ugly picture. The Nifty is down 500 points. Of course, we'll wait for these rates to adjust, but it doesn't look like a good start at all. Metal, cement, power, banks. It's a secular run on the downside, is what we're getting in pre-opening. Samir, good morning. Good to see you bright and early this morning. I just wanted to understand what the outlook is for the rest of the year, because give and take everything, this market has done pretty well.
I think the way to look at it is that we are outperforming. We will again continue to outperform, but I don't think we are going to make more money from here for next 3-4 months. And maybe we give back nearly all of it, or that I don't know. But generally, we can only be happy that India most probably will outperform China, Europe, US, because you can see some specific, even beyond inflation issues, although maybe US is mostly inflation. But if those markets are down, and I think now they'll be down quite a bit, then we will outperform. And I think that is the best we can hope for the next few months, particularly. Okay, let's go month by month, who knows. But September, there's nothing new to look except negative things on US inflation and employment, and then their 50 or 75 basis point hike. And then for us also, we may be happy with some results, not happy, but that is many weeks away.
Hi, Samir. Morning. Always good hearing your thoughts. Samir, what about the long shot? How have you all changed your positioning, say in the last, in the recent past? If you could give us a sense on that.
It will be changed soon. That's what I said. No, I tell you, before I even do many of these things, it has to be changed.
But how are you all positioned as of now? If you could give us...
Right now, we would be high. I mean, our normal average for the last, again, I say for 17 years has been 62%, and currently we are at maybe 68 or so, and it should be brought down.
Samir, so just to press on that point, you said may give back most or all of the gains. You're saying what you mean is from the June lows.
What I mean, easily go back 5-10%, 10%. Okay, you say it's 18, but that is precisely from some maybe intraday bottom or something. Broadly, we feel it's up 8-10%, generally speaking. Big picture, because I don't even look at it that micro. For example, if you ask me right now, what is the sensex? I have no idea what is the number. I only talk in percentages.
No, from the lows of 15,200. Yeah, you're right. That was the intraday low. That's almost 18%, 18.5%.
How much?
18.5%.
That's what I'm saying. You said 18. If you had asked me without this, I would have said maybe it's up 12-13% or 10-15%. So in that big picture context, I'm saying it can lose 8-10%. Yeah. But I don't know exactly whether it is supposed to hit some magical number or not. The point being that, if those guys increase their rates, although we may say not connected with us, but then that creates a lot of problem for RBI, whether they should increase rates, or if not, then what to do with currency. Well, they can do one thing. They can raise money from NRIs, and they can get 30-40 billion if they want, and maybe then they don't have to raise rates, or they don't have to defend the currency via rates. But all these things are a bit complicated and are not going to happen in 2 weeks. So there will be good uncertainty, high uncertainty. And also, if you look at the language, although we have discussed this in the past where Powell was asked that will you take draconian measures if needed? And, instead of saying, no, draconian is a bit too much, this I'm talking about March, from the time I became really negative. He says, let history record that my answer is yes. Now, what kind of language is that from like a Game of Thrones kind of thing, which means you are totally committed to say, let history record that my answer is yes. So if he was in March saying that he will take whatever, and the word exactly was that will you do whatever it takes, and then one Fed, which was Volcker, had taken draconian measures. So would you do the same? And instead of saying, yeah, I'll try, I have to manage this, that, he said, let history record that my answer is yes. So now he seems to be again trying to reestablish his credibility, because if you look at some of the discussions that even I see on Twitter with me, people say, oh, the US cannot handle, they are hooked on easy liquidity, they are hooked on easing, and therefore they will not do. And I say, well, I don't know, but this guy just said a few weeks ago that I will take draconian measures. So that basically in simple terms means that the markets, including me for 2 months, were enjoying and saying that, okay, things are over and it is peaked and therefore it is on the way down. But they are saying it is not enough for inflation to have peaked, but for us to see that it is going to 2%. In the long term, they may have to change this 2%, I think, but not today. You can't do it in the middle and say, no, I have made my goal 3%. But when it is going towards 3, maybe one day somebody will say that because we are doing less globalization, because we want to not rely totally on China, we will do some things here, and the cost of that is some 50 basis points higher inflation, but that is a trade-off. But you can't do that today. So today, if they've just again said it, we have to believe that this is not ending right now.
Yeah. Nobody was expecting a pivot or anything, right? I mean, but I think what has happened maybe is that in terms of what has changed for the market is those who were expecting some rate cuts in the second half of next year, first half of next year, that is now out of the picture.
Yeah, so that's a dovish pivot in the sense that even though you're raising rates, you keep talking about, or you hint that don't worry, next year it's over. So you just look at it as a 1-year issue or 6-month issue. But if you say, no, it's longer, whatever, higher for longer or whatever, and you say that we will take whatever their long-term trend growth has sort of par for the course, then yeah, it's been bad right now. I'm in a bad mood today early morning just because I'm wearing a cotton shirt at home. It looks very colorful, but I ain't feeling colorful.
You're looking cheerful, so if that that works, I think. You can manifest your moods, right? You know that. I mean, look cheerful. Maybe the markets will pick up. You never know. But Samir, by the way, just want to point out that the rupee has hit. Yeah, go ahead.
Try this. Sorry, one thing you must try. Put a pencil here, and you can't be angry. If your face is always smiling, you cannot be angry, even if you force a smile. This is from the book Thinking Fast and Slow. Okay, yes, sorry, your question.
No, that would work. I don't think I need it. I mean, I'm smiling all the time, so I don't need a pencil over there. But I mean, for tough times maybe. But I just want to point out that the rupee has hit a record low of 80, and I think this was coming because forex reserves had also slumped to an over 2-year low, and there was some RBI intervention to prevent the rupee from, crossing that 80 mark. But today, once again, the rupee is at a fresh record low of 80.08. Samir, back home, there is a big move that we're seeing in a lot of the consumption stocks, whether it's auto stocks, whether it's the FMCG basket, the Jubilant Foods of the world. This entire pocket has picked up, and one step out into the markets, into, a mall, and you'll get a sense that consumption has come back in a big way, even real estate for that matter. Is this a space that you like?
So, we have liked the sort of the low ticket consumption, if you call it that. And now if I want to make it a second round event, that if interest rates have to go up, even in India, just to, not have the currency depreciate, then impact of that will be on your auto and maybe a little bit of real estate, but not so much on your going to the mall or you're going to buy shoes or wedding dresses or whatever stocks we have. So broadly speaking, I would still think that consumer low ticket is better, because in the end, I think the Indian economy is doing relatively better. You just compare it to what is happening in Europe, what is happening in China, where they are now saying some 3.5% GDP growth, and US, because they want to even if the economy is doing well, they want to bring it down in some sense to make financial conditions tighter. So in that relative sense, there are only 4 big pockets in the world: US, Europe, China, India, and India is very good. So we can't totally walk away from India. We just have to, reduce our exposure a little bit to some things which may be more direct. So I would think I like consumer, but within the consumer, I have to like consumer low ticket better than durable type. Actually, durables I don't like anyway, because I think everybody in India, if you see, everybody wants to have their own TV brand, and they want to make washing machines, and they want to make microwave ovens, and they want to make toasters. I think there's a limit to how many people or how many companies can do the same thing.
Right, Samir, let's talk about, the stocks that were in focus in the past week, particularly the tier 2 banks. In the past, you have been a big fan of the HDFC banking name, and you said you're keeping the faith out there. But what about these tier 2 banks, some of those RBL Bank, IDFC First Bank, Central Bank, the names that really don't come on the radar, but for the past week, suddenly they went up 10-20% odd. Would you?
So we have 1.5 of these names. Because we have IndusInd also in our list. And from this, we have one small position in one of these, a new position from bought actually last week or maybe last week only. But now I'll have to see. And maybe if I reduce somewhere else, then, the financials might at least relatively outperform for sure. See, now the first question will be whether the FIIs, do they just slow down, or do they stop, or do they reverse for now, for let's say month to month, based on whatever is been, an outcome of this Jackson Hole. So let's see. But right now, today, I have no intention to buy anything much, to tell you clearly.
And, the other call that you had taken, I think, was on Zomato. You got in on that dip. What do you do from here on?
Nothing. Keeping, at least let us make some proper 50-60.
I recall you got it, I think 48 to 50, if I remember.
I bought a little bit more. My average has become 52.
Oh, okay. All right. So you're adding on to that position.
No, not now. We added that time.
Okay.
But whatever. So the bottom line is, right now, let me enjoy it, because I can't be negative on everything together.
Samir, when you said that market here will outperform other markets, you essentially basically saying this largely a function of the mood here is, people keep saying people are very bearish, etc. But on Friday, futures were at 100-point premium, the largest premium in a year, Nifty futures. So is is this a function of what you're saying? Outperformance is a function of local flows. You expect them to be pretty strong. Continue to be very strong?
Local have generally been strong, so even if they continue at current levels, I'd be okay. I was thinking more when I was saying that we are bullish, in this last 1.5 months and all, was that I said that broadly speaking, the FII selling will stop someday, and by just chance it stopped sort of in July itself. But broadly speaking, my big picture thing was that every year FIIs are normally net buyers, and that has been the case in 21 or whatever out of 25 years. So they will come back plus minus a few months. It just happened that they came back quickly. Now it again depends on, if I want to be bullish in a good mood, I'll say FIs are back. If I'm in a bad mood, I'll say, yeah, they are back, but they bought what was sold by a foreign private equity guy. So in the end, how does it matter? But it matters, because the guy who's buying is coming in today with a new enthusiasm and a new view of the world. And as I also tweeted last week, or whenever we had this conference in Singapore, I think the Edelweiss conference, it was amazing how badly people have been hit in China. I was going to use a stronger word than I realized I'm on TV, but how badly they've been hit in China, and really badly hit, which is causing them to have redemptions across their Asian funds, emerging market funds. And if you just put the 4 pockets, India, China, Europe, US, it's just easy to see that India is doing well, both in terms of inflation, both in terms of interest, and most directly in terms of relatively people moving a little bit, if not all, or most of their new allocations from China to India.
Yeah, okay. Samir, last time when we spoke with you, you said you are staying away from auto stocks. You're getting a FOMO feeling?
No. I don't feel FOMO. I have been around for 25 years. After some time, you will feel being included, whatever is called the reverse of FOMO. Don't worry.
You said that we could easily give back what we have put on, maybe 8-10% or is par for the course. The low that we made in June, though, do you think that level should hold out at least?
Well, I don't look at it like that. I didn't even know what the exact low was. But broadly speaking, in my mind, giving up 5-10% looks, not in one day or 1 week, but generally in this round is okay. So I don't look at it like that. I have no idea what exactly was the low when it was hit. I don't look at these things. So it doesn't stick with me.
All right.
Things.
It was just 15,200. So you're just wondering where they had the view. But we take that point. You're expecting us to drift a little bit lower from these levels. Got that?
Well, I wanted to take Samir's point. I think the last time he spoke to us, he said he's staying away from IT stocks. I guess that worked bang on, Samir. The stocks have been under a lot of pressure. Margins are at multi-year lows. But do you think this whole structural growth story of IT that has worked very well in the last 4-5 years has come to an end entirely? Or will it come back into fashion at some point?
No, some point everything comes back. It's not that it never comes back. The question is whether it comes back over the next 6-month type. Then, you can hang around and wait, or you then otherwise have to take some view. So I don't think it's easy for it to relatively outperform our market, whatever it may do in absolute, because at the end of the day, if the US customer, the European customer is under pressure, and whatever they may say about its secular, this thing that, obviously, they have to invest in technology, and then India is the back office for them, and India can handle new things that are happening. But, we know it, that if there is pressure on the end customer, then the whole supply chain has to share the pain. And also discretionary projects may reduce, and new startup businesses and businesses from these PE-funded companies may have come down already or will come down. All that has to happen if the whole idea of the Federal Reserve is to slow down and bring down the market in some sense. I think if the market doesn't come down in the US, then the Federal Reserve feels that, they are not taking me seriously.
I mean, markets rallying is easing, right? Conditions generally.
It's a sign of easing financial condition, but even psychologically, if you keep saying, I will raise rates, and the market says, it doesn't matter because anyway, X number of months later, you're going to cut it, then that is the signaling of no credibility. So then he says, no, now I'll show you even more. So the best is to act dead.
Samir, have you guys participated in any recent? There was this IPO Sirma. I mean, good company. Well,
no idea.
No, nothing. Okay.
Zero.
And all these blocks, etc. Also, which we've seen, you were referring to earlier.
No, so we didn't do it in the block, but we bought the Zomato like one day before because we bought on the result, and then the next day the block happened. And then the other ones, I didn't imagine that it'll be that. I used to think that's a big overhang. It turned out to be a cleaning up trade, but of that size, it was amazing. No, we didn't buy.
Which one was that? Zomato?
No, I'm saying the other blocks like that,
okay.
Max,
etc. Max, some 30% equity changed hands, and the stock that day was up some 10%, right? Yeah.
But we didn't buy. In fact, till one day before, we used to think that, we are not buying this stock because there is such a big overhang. And how will this overhang be absorbed? But it was brilliantly done. But we were not.
So, just coming back to the overall market picture, Samir, if this market or if global markets head into a recession by the end of the year, which is, I think, the base case at the moment, not just for the US, but even what's happening in Europe, right, with that major energy crisis. Do you think, how does it work for a market like India? Do you think money will move out of developed markets and into markets like India because the potential looks better here? Or overall, do you think risky assets could become unfavorable?
So I would think that these things don't happen in one shot, that if you are disappointed with one market or one stock, you instantly sell it to buy the other market or the stock. But over the next X number of months, with God knows how many, let's say 6 months, then once people reassess, they will then say, yes, India is doing better and it has outperformed and there is a logical case for why it has happened. Then you can get, but for example, if today a tech company comes out with poor guidance, let's say just for the heck of it, Infosys, in 30 seconds, people don't switch from Infosys to TCS. They would rather sell TCS also because they say, oh, it's part of the same asset class in this case, or in our case, industry. And then 3 months later, 2 months later, then they evaluate the two again and say which one to do. So I don't think that movement from developed to emerging happens in one stroke. It will first happen by them selling that, maybe not selling a lot here or selling less here, and then the Indian public buying its own market, and therefore we outperforming. And then over the next 3-6 months, you get the benefits of all these things that we feel we are doing well in, which is growth and tax collections, and that at least we are not having such high inflation, and that our interest rates are relatively higher than all these places already, and whatever else we may have done in the past few years in terms of reforms and everything else, digitalization or demographic. But it doesn't happen in 30 seconds that you get hit with the US market and you move that money to India or any other market.
Always good hearing your thoughts. Samir, thanks so much for stopping by and filling us in with your view on the markets, the FIs, and a whole host of sectors. Always look forward to chatting up with you rather soon.